You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello, welcome to The Investor Way with me, Sam Ball. It's the 19th of May 2026, and I'm joined today by my co-host John McEwen. And in this week's episode, we'll be discussing Aston Martin, Unilever, Whitbread, Magnum, GSK, and our US company of the week is Coca-Cola. John, should I start us off with Aston Martin?
Yes, how are our favourite car manufacturer doing?
Absolutely. We'll get what will almost certainly be the pick of the week out of the way first. Aston Martin, they have come out with their Q1 results, and first quarter revenue rose 16% to 270 million, driven by a sharp increase in deliveries of its special models, which carry higher average selling prices. Underlying operating losses narrowed by 12% to 57 million, largely as a result of the revenue growth. Free cash outflows improved by 3% to 117 million. And I think this is the killer, really, that the cash is still just pouring out the door, with reduced capital expenditure helping to offset cash being tied up in inventory. Net debt rose 15% to 1.5 billion. Full year guidance has been maintained, with car deliveries expected to be similar to 2025's levels of 5,448. Underlying operating profit is expected to improve towards break-even, helping to materially improve free cash outflows. And the shares rose 6.7% in early trading. It's worth going over the tariff regime. So for cars, the first 25,000 UK cars to be exported to the US each quarter get a tariff of 10%, and that's first come, first serve. Anything over that gets a 27.5% tariff. Now, I actually read that and I thought, well, I can't see that having a huge impact on Aston Martin. I'm sure America is a very good market, but I'd have thought it'd be more Europe and Asia. However, when I checked what proportion of sales actually were from the US, it's actually their largest market with 34% of sales. So that policy is basically a disaster. In terms of the price, it trades at a forward price to sales ratio of 0.26. That compares to a 10-year average of 0.96. There's no earnings, there's no dividend. I'm surprised the shares were up following these results. I think although the profit and loss numbers look a bit better, you can see it with the debt. As we have joked about before, it has famously gone bust 7 times. I think it will soon be 008. And the P&L might look a bit better, but the Valhalla launch was delayed. They needed that to be basically perfect, and it wasn't. And you can still, even though it's catching up, you can see the impact of that in terms of that free cash outflow and the debt piling up. And I just could be proven wrong, but I just think they're in so deep a hole, I really can't see them getting out of it. So I wouldn't touch it with a barge pole. And I'm surprised the shares reacted the way they did when that cash figure is just so poor. What do you think, John?
Yeah, I think uninvestable for all the reasons you said. I like the product. Oh, I'd love to own the product, I should say. But it's sad, isn't it? Interesting to follow.
There's a glimmer of hope from these results.
No, well, I mean, maybe a little, but I think the odds are really stacked against them. So I unfortunately don't see them digging themselves out of it.
So in that case, shall we move on to a company has historically been a favourite of the show?
Yeah, well, it has been, and this is another sad case, and it's a company that I own, called Unilever. For anybody who doesn't know, it owns a huge number of household brands, a lot of which it's actually sold off in recent years, and Magnum, the ice cream business, is one of them. Anyway, they had a new chief executive, as we've talked about before, in the last year, Fernando Fernandez, and they've got a Q1 trading statement out with reported first quarter sales of 12.6 billion euros, reflecting underlying growth of 3.8% against 3.6% expected. The uplift was driven by a 2.9% increase in volumes, with higher prices making up the remainder. Growth was broad-based across all business divisions, and by region, emerging markets continued to grow at a faster pace than developed markets. And that was driven particularly by a strong performance in India. Full year guidance remains unchanged, with underlying sales growth expected to be toward the lower end of its 4 to 6% midterm target level. And a quarterly dividend of 46 cents a share was announced, which is up 3%. And a new €1.5 billion share buyback program begins today, and it's expected to be completed by the 6th of July. The shares were up around 1.5% in early trading. In terms of valuation, the group have a market cap of £93 billion and trade at 15 times forward earnings, compared with a 10-year average of 17.8, and they're currently yielding 4%. So I think on the surface, I mean, it's nice to see that guidance has been uplifted. But I think if you're looking at it purely the investment case today compared with a few years ago, I think a few years ago there was the argument that they hadn't invested very well in a lot of their core brands. And therefore, you'd seen lackluster growth compared with the competitors like Nestle. And therefore, they got a new chief executive in, Heinz Schumacher. The idea was that they would reboot their traditional brands and that would drive the growth forward. So investing in what they already had. Unfortunately, Heinz Schumacher was sacked and Fernando Fernandez came in. Was very highly rated, and certainly there are a number of financial journalists who rated him, and also Terry Smith thought very highly of him. He was the group's former CEO. What we hoped for was that they would get to grips with cost, but also reinvest in those brands and grow the power brands forward. Unfortunately, the approach now seems to be a continuation of what had happened a few years back, where some parts of the business were sold off. So there was the selling of the tea business, there's the selling of the spreads business. I suppose I understood the spreads business a little bit more in terms of people were reducing how much carbohydrates they were having and therefore the spreads that they had on top of them. But then came the ice cream business and also the rest of the food business that's now being sold off. And it's also being sold off. It's not for cash, it's cash and shares, and it's McCormick, which is fairly highly leveraged, buying it out in the US. And it really feels like it's more of a short-termist approach to release the value rather than sort of growing it organically through that portfolio of fantastic brands that they've had. And I also think that if you're going, almost purely into more of the sort of beauty market, that and personal care, that is really competitive, and you're up against the likes of L'Oreal, etc. And I think one of the great strengths of Unilever was that it was quite diversified across a lot of consumer goods. And it just feels like now there's a race to release that value really quickly just by selling off parts of the business. And what you're left with at the end, I don't think will be anything like what you had before. And it's just, well, for someone who's owned Unilever for getting on for 15 years, it's just quite disappointing. And it's not the direction I saw things, going in. So I am really weighing up whether I continue to hold Unilever, given this is the strategy that they're following. And if I were looking for a consumer goods company, I know we haven't covered it in a little while, I'd wonder how Nestle are doing, because they've also got an excellent portfolio, but they're not adopting this, as far as I see it, short-termist approach. Sam, what are your thoughts on the Q1 statement and the approach Unilever are now taking?
I think the statement's quite disappointing, just because we'd covered the full year results. The new CEO, it felt like they were quite lackluster, especially given how highly rated he was. They didn't seem that different to what we'd seen under the previous 2 or 3 CEOs. I think it's picked up a bit, but I still don't think it's really putting up the kind of numbers that justified sacking the previous guy. So I think he could have done that. And then you've got this total change in strategy where it's basically, we'll just basically gut the business and sell off the family silverware. I don't like that as an approach generally. I think one of the things that's always been attractive about Unilever is it is this big conglomerate and you've got all these fantastic brands. Like you say, I understood getting out of spreads. Tea, I didn't feel quite as strongly about. Ice cream, I didn't love that because although I could kind of get ice cream, I guess, but I didn't love the strategy itself because it just seemed like they were giving up. And the ice cream brands, some of them were just fantastic. But the fact that they were spinning it out meant that you could continue holding it. And I could understand the argument that it was lower margins. But because you could continue holding those shares, there was almost no harm. Whereas I think with the sale to McCormick, especially with part of it being in stock, we've not looked at McCormick, I think, for a couple of years. But compared to Unilever, compared to Nestle and other consumer goods companies, when we did cover it, it always seemed eye-wateringly expensive. They might be at sort of 15, 17 times earnings. It was at 30, 35 for brands that, although they were pretty good, I wouldn't say they were that much better than what Unilever had. So yeah, if I was a shareholder, I think at this point, unfortunately, I'd just be calling it a day, because where do you go from here? Like I wouldn't want the McCormick stock. I wouldn't want to just sit and wait for it to be sold. And, in the event that the sale doesn't go through, have I seen enough from this CEO now in the sort of year and 3 months or whatever he's been in to justify holding on? Probably not. But then as well, he'd probably just be looking to sell something else. I think that kind of is the strategy now, just unlock the value by sales. So yeah, I think it's a shame, because I think it was a great company. Although in fairness, in the whole time we've covered it on the show, it's never really put up the numbers it maybe should have done.
Yeah, no, it is sad.
Should we have a look? I'll just check what the PE of Nestle is at the minute. I mean, in fact, it's down about 7% in a year. He's saying the PE is just under 23, so you are paying up, but I guess its figures have, although it had a bit of a wobble last time we looked at it, I think its figures had historically always been a couple of percentage points higher than Unilever. It'd almost been putting up the numbers that you felt like Unilever should have been.
That's right. And it was always just around the corner. The next CEO, he will make the most of the brands, but I think we're seeing the
I think we're running out of CEOs now.
Yes, that's right. Okay, shall we move on to Whitbread?
Yes, so Whitbread, I'm sure everyone's pretty familiar with it. We've covered it multiple times. They are mainly known for the hotel Premier Inns. That's basically what they've got left now. Although at some point they seem to have owned pretty much everything on the high street. So they have come out with their full year results, and full year revenue was basically flat at 2.9 billion. Growth in UK and German accommodation sales offset the fall in food and beverage revenues that accompanied the branded restaurant disposals. So I think with that in mind, that's probably okay. Underlying cash profit grew 4% to 1.1 billion, despite higher than expected cost inflation in the core UK business. Free cash flow decreased from 0.4 to 0.1 billion, reflecting increased capital expenditure. Net debt, including leases, grew by £500 million to 5.2 billion. The final dividend was held flat at 60.6p a share. Accommodation sales are up so far this year, but net inflation guidance in the UK has moved to the top of the previous 3 to 4% range. The ongoing restaurant disposal plan is expected to drive a 40 million hit to the bottom line. The shares were down 3% following the results. Management is yet to introduce a buyback for the year, although apparently they are planning to release some capital, which is going to be financed by 250 million in cost savings, and they're targeting to distribute 2 billion of free cash flow to investors by 2031, and that's on a market cap of 3.93 billion. So that if they can do that, that's not bad at all. If they can distribute half the market cap in the next 7 years. The main thing I think that's of interest is the German business. The UK is pretty saturated, but in Germany, as we've discussed before, that sort of level that they operate in the UK, it's much more fragmented in Germany. So they've been basically going and expanding in Germany, and that's been going quite well. So Premier in Germany for the year, total sales grew by 13%, and they've said they strengthened their outperformance versus the general market. And that was driven by the growing maturity of the hotels and brand, as well as the positive impact of the commercial initiatives. And the segment adjusted profit before tax was 2 million, and that's up from an 11 million loss in the previous year. So again, that has been, I think the strategy's been the right one in terms of the German expansion, but it has been taking a hit on the bottom line. They are now, the German divisions they've got, the German division is now profitable. The debt's, I guess, quite high, but that's been funding sort of German acquisitions. So I don't have a huge issue with that, because I think that German strategy is the right one. And it looks a bit worse just because Germany's still not quite delivering the profits it will. And I do think it will deliver those profits. In terms of the valuation, it currently trades at a forward price to sales ratio of 1.31. That compares to a 10-year average of 2.45. The prospective yield is 4.3%, and that compares to a 10-year average of 2.4%. And in terms of the PE, that's at about 11. So yeah, I think it's pretty attractive. I don't know if I'd go out and buy it because of the industry, but I think one conversation we actually did have recently was there's not many great shareholder benefits offered by FTSE listed companies, but with Whitbread, I think if you buy about £1,700 worth of shares, that will entitle you to a free breakfast whenever you stay. Now, I don't think it's a bad company, and I do like the German strategy. I think at a P of 11, I don't really stay there enough to get those. If I was staying at Premier Inn quite a lot, I probably wouldn't mind throwing 1,700 quid at it for the free breakfast, because I think at that PE it could do well. It could still do quite well as an investment. But if not, I think your loss will be covered by free breakfast. So, John, what do you think? And does the free breakfast tempt you at all?
I think for a small shareholding, possibly. But more seriously, I think they are well run. I think the strategy is the right one. I wouldn't have seen it a few years ago, but actually, the more that we look at it and the more we hear about the German growth and the fragmented nature of the German market, I think it's so far being well executed, and hopefully you will see it in the bottom line in a few years' time. I don't think it's outrageously expensive either. In fact, I think it looks quite cheap, but it does have some inherent risks, and the industry is certainly not one that's in favour at the moment.
Shall we move back to our Unilever theme?
Yes, so Magnum Ice Cream, or the Magnum Ice Cream Company, I should say, which owns Magnum, surprise, surprise, but Ben & Jerry's, Walls and Cornetto. And interestingly, that's 21% of global ice cream sales, which is more than double that of its nearest competitor. Anyway, they had their Q1 trading statement out, with the group reporting first quarter revenue of 1.8 billion euros, reflecting underlying sales growth of 4.5%. This was driven by volume and price growth of 2.9% and 1.6% respectively. And sales across all regions were in growth territory, with Africa, the Middle East, and Asia growing at the fastest pace, up 7.9%. Full year guidance was reiterated, with underlying sales expected to grow between 3 and 5%, and underlying cash profit margins are also expected to improve by 0.4 to 0.6 percentage points, and the shares were up around 11% on the statement. In terms of valuation, the group has a market cap of £7 billion and trades at 11.8 times forward earnings. Nothing really for comparison just because it's so newly listed. But I thought these results were encouraging. I think to really get things going, it's going to be a case of paying down the debt that they were left with from the spin out from Unilever. But some of those, particularly emerging markets figures, with Africa, Middle East and Asia being 7.9%, that's very good. And the rest of the figures are, I guess, similar to Unilever, but underlying sales growth 4.5%. And I think with the quality of those brands in there, it's certainly not expensive. One concern, I think this is for all of the ice creams, is that if you did have a world in which everybody or every man and his dog were on a GLP-1, so like a weight loss injection or tablet, what would that do to sales? Because you'll have a lot of people who will be fairly heavy users with Magnum, and if they dropped off significantly in terms of top line, where would it go? That is one concern, but I think, given its dominant position in the ice cream industry and the price, 11.8 times forward earnings, I think it's fair enough to take that risk. And I don't think it would be particularly big, on that basis. Sam, what are your thoughts on Magnum? Would you continue to hold if you got some as a Unilever shareholder? And as someone who doesn't hold Unilever shares, would you be looking to buy any Magnum shares?
I don't think I'd be looking to buy it. I think that's mainly just opportunity cost. But, last time we covered it, we basically said it was kind of too soon to tell. You need to sort of let it put up a few quarters of results before you decide, I think, whether you're going to keep it or sell it. But I think those numbers are far better than anything we've seen from Unilever in the last few years. So, yeah, I think at a forward P of 12, if I'd got that as a spin out, I'd be holding on to it. Which is quite ironic, really, because it'd be Unilever I'd be thinking of getting rid of. But yeah, it's surprising. Yeah, I think it looks like it could be. And you think as well, they've not even finished paying the debt down yet.
Yeah. Okay. Very good. How are Glaxo doing?
So, Glaxo, for anyone who's not familiar, it's GlaxoSmithKline. They're a pharmaceutical company, and they have come out with their Q1 results. So They were broadly in line with expectations, which was up 5% to 7.6 billion, excluding currency impacts, and growth in specialty medicines and vaccines more than offset a decline in general medicines. A favourable shift in product mix and cost reductions helped drive underlying operating profit up 10% to 2.7 billion. Free cash flow increased by 0.1 billion to 0.8 billion, and net debt now stands at 15.6 billion. The quarterly dividend of 17p a share was declared, with 70p expected for the year as a whole, and the ongoing £2 billion buyback has 300 million left to go. 2026 guidance is unchanged, as is the sales outlook for 2031, where they're targeting over 40 billion. And this year, the sales are expected to grow by 3 to 5%. Shares fell 2.4% in early trading. A lot of the sort of key clinical results in the pipeline are more weighted towards the second half. They do have a headwind in US vaccine sales, but they're saying that they're being offset by stronger demand in the category overseas. And net debt now stands at about 1.4x cash profits, which I don't think is terrible. In terms of the valuation, they're trading at a forward PE of 10.9, and that compares with a 10-year average of 10.5, so pretty much in line. However, the prospective yield is 3.6%, and that compares to 5.4%. However, they are doing buybacks, so I guess that's where you're getting that extra yield, really. In terms of the market cap, it's 76 billion. That 3 billion buyback is only a few percent. It's not hugely moving the needle, but I think combined with the dividend, those returns are fairly decent. I don't know if I actually recently sold my Nordisk. I've not got any desire to get back into pharmaceuticals. In fairness, I probably would have held on to Novo Nordisk, but I basically wanted the money for something else. But I broke my rule of not investing in stuff I don't understand. I can't say I've come out of it particularly well. I'm not particularly keen to buy another pharmaceutical company. That being said, if I were to buy another pharmaceutical company, at this point, I would probably just buy more Novo Nordisk, given how cheap it is. So yeah, I wouldn't be interested in Glaxo or AstraZeneca for that matter, despite the fact that they both look better run than Novo Nordisk at present. John, as someone who does still own Novo Nordisk, what do you think of these results?
Yeah, well, I think with Novo Nordisk, the company itself and the product are probably a bit easier to understand, and the pipeline with Novo Nordisk too. So it does make it a little bit easier to make the investment case for it. I suppose with Novo Nordisk, it's quite different to Glaxo in that it's almost a pure diabetes play. And the big thing which makes Novo Nordisk so volatile is that it was the first into the GLP-1 market, and then that's subsequently been really disrupted by competitors, particularly with Eli Lilly. So I think there is a different argument with Novo Nordisk, and I am actually quite comfortable holding Novo Nordisk. I think when you look at pharmaceutical companies like Glaxo or AstraZeneca, you need, I think, a lot more specialist knowledge really to be able to understand the pipelines. And if you had a deep understanding of the pipelines and where different drugs were and what the likely market size is going to be and all of those things, then I think you'd probably be able to make investment cases potentially for it. I think without that, it becomes quite dicey. And I think if you're a retail investor, you could take the view on pharmaceuticals and have a basket approach quite easily. But I think if you're going into individual ones, particularly ones like Glaxo, which have the portfolio spread across a number of different areas, and same with AstraZeneca, then you do need that knowledge. In terms of the results, I thought they were, fairly good. It's quite interesting. Shingrix, which is the shingles vaccine in the UK at least, that was pretty rationed before. They were using an older vaccine before, and now everybody is basically who's eligible for shingles vaccine is having the Shingrix. And I think in their results, you saw that. So it added, what was it, £1 billion to the top line, something like that. That's interesting and one that I recognise. In terms of other things, oncology, so it looks like they've done pretty well in oncology. That's always one of the divisions with the sort of cancer treatments where they often, or sometimes can find a blockbuster, can make a huge amount of money, moves the shares a lot. And I think that is a division that you've seen AstraZeneca, and this is just purely by following, the results, outperform Glaxo really significantly over the past 10 or 15 years. And part of the reason AstraZeneca has done so well. The shares, they look cheap on paper. I wouldn't be going near it on an industry, for industry reasons rather than anything else. But I do like to see British pharmaceuticals doing well. I think over the last 10, 15 years, AstraZeneca has massively outperformed. Real positives, if you were to look at Glaxo as a company, I suppose it probably is more the vaccines division. That's been something that they've been really strong with. And again, just comment on the strategy previously. Astra had always had that pure play with, just pharmaceuticals. And Glaxo had the consumer health division, which they've spun out. We've covered Haleon plenty of times. And then they've also had their sort of actual pharmaceutical business. And the idea being that you could argue it's sort of defensive, but it's also cyclical when it comes to some of the pharmaceutical businesses, in the sense that they will have some blockbusters and then they may go through times where things dip and it's a bit dry. And the consumer goods had helped balance that out. I think since returning to the pure play, you have seen it swing a bit more, but I think the initial signs are probably encouraging.
Shall we move on to Coca-Cola then?
Yes, so a much less cyclical business, but incredibly defensive. And I mean, what a brand. We cover it over and over again. This is Daddy Coke that's over in the US. They had their first quarter results out last week with first quarter underlying net revenue up 10% to $12.5 billion. That was against $12.2 billion expected. And growth was driven by an 8% uplift in volumes, which is just incredible, while higher prices contributed to the remainder. Underlying operating profit rose 12% to $4.3 billion against $4.2 billion expected. And the uplift was driven by top-line growth and a tight grip on costs, which saw margins improve. Free cash flow over the period was $1.8 billion, and net debt rose from $29.7 to $30 billion over the quarter. Full-year underlying net revenue is expected to grow between 4% and 5%, with free cash flow of around $12.2 billion, and underlying sales per share growth guidance has been raised from 5 to 6 to 6 to 7%. And the shares were up around 2.5% in early trading. In terms of valuation, the group have a market cap of $347 billion and trade at 23 times forward earnings, which is in line with its 10-year average. And they have a prospective dividend yield of 2.9%. Given the size of the business and that you feel like it's saturated, wow. Net revenue growth of 10% with an 8% uplift in volumes, I think is incredible. Yes, I suppose you would say it is reflected in the price, but it is such a high quality business. And I think it's interesting if you look at it, and I know we've spoken about this before, but one of the differentiators for Coca-Cola is its operating model, and that rather than doing all the manufacturing themselves, they partner with and hold stakes in local bottling companies. So Coca-Cola HBC is one that we've covered and that we've liked a lot on the show. And that's what they call the Coca-Cola system. It also has brands like Fanta, Sprite, Schweppes, amongst, I was going to say Costa Coffee, but that was maybe one to skate over. But it has a number of brands within the portfolio, so it's not just Coca-Cola. And I think one of the remarkable things is that you could have said, well, with sugar taxes, even with things like GLP-1s, people wouldn't drink these drinks anymore, but they've reformulated a lot of them. Obviously, they've kept the original Coke, and they've got lots of sugar-free and sort of healthier alternatives. So in the face of adversity, they really powered through. So that's a testament to the brand and the management. Sam, what do you think of these results and Coca-Cola as a company?
It was a company absolutely fantastic. Can't really fault it. In terms of the results, unbelievable. I guess I just bear in mind they cannot do that every quarter. I mean, no one's walking around kind of anywhere in the developed world thinking, I wish there was somewhere I could get a Coca-Cola. They could not be more saturated, but yeah, that's just unbelievable. I think it a forward PE of just under 23. I think for the quality, I think you could probably make an argument for it. I don't think I would pay it, but I can see why someone might. And it's in line with that average. And we have seen it more expensive. I think we've seen it closer to 30. When it was putting up worse figures, actually.
Yeah.
But yeah, I think you could do a lot worse. Personally, I would rather have one of their bottling partners. And I would specifically want Coca-Cola Hellenic Bottling Company. I think I'd be much more comfortable buying that, as we've discussed when we've covered it. But yeah, unbelievable business. And worth noting that Coca-Cola is the higher quality business because it's not having to do the operational side outside of North America, because it has those partners like Coca-Cola HBC.
Yeah. Okay, well, on that then, what is your pick of the week and what would come last?
Oh, that's quite... I don't feel like... I mean, in terms of the business, it would obviously have to be Coca-Cola, but I just think in terms of the price, I think that's what puts me off slightly. So I think I'd probably actually go with Whitbread, because I think it's a much more attractive valuation. Last... I might do Magnum, actually. No, I'm going to stick with Whitbread for the free breakfast. Okay. And then I think last is quite easy. It would be Aston Martin. What about you?
I think I'd probably go with Magnum, albeit with those, the potential risks with the GLP-1s, but I'd go for Magnum. I think the valuation currently is attractive. It's one that I hold and will continue to hold, but if I didn't, that would probably still be the one I would go with. In terms of last, well, that's an easy Aston Martin, sadly.
Right. I think that's everything in that case.
Well, thank you very much for listening, and we will see you again next week.
See you next week.
You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter @TIW Tweets.